This is Jody Trana with a presentation for Unit 2, Reporting and Evaluating Cash Flow for the course Cash is King. In the last unit, we built a foundation for understanding cash flow. That was Unit 1, Cash Flow Basics. This unit builds on that understanding and concentrates on the ways that cash flow is reported and evaluated. In doing this, we will review some of the popular ways that cash is recorded. Some are more effective than others. And we'll also talk about the way that people generally need cash when they are operating a business. There's two main situations. First, either they need an overall improvement to cash flow. That basically means having cash when it is needed. Or they need cash for specific uses, such as equipment purchases, a growth plan, or seasonal fluctuations. And of course, it's possible that the business might have both needs, a need to improve cash flow and cash for specific needs. Ashish Thakur is now the youngest billionaire in Africa. He knows all about cash flow, and he even knew about cash flow when he started his IT business at the age of 15 years old. At that time, he was selling IT supplies in Africa that he had purchased in Dubai. Well, he didn't have enough cash to pay for cargoes and shipments, so he would travel to Dubai every weekend. He would purchase IT merchandise, pay taxes on Monday, and sell products the rest of the week. Then he would take his cash from the week and go back to Dubai for the weekend. He did that for 6 months, and then he decided to become part of the solution. He set up a business in Dubai that would ship IT equipment to Africa. Today, his company, Mara Group, is in 24 countries with 7,000 employees. He mastered the art of cash flow, starting with just the basics. Now, I think cash flow is easier to understand on this small scale. Selling products during the week to pay for products purchased on the weekends. But the concept of cash flow is the same, no matter the amount of cash. The checkbook is probably the most common way that entrepreneurs measure cash, at least early on. Like Ashish Thakur of Mara Group, they simply ask, how much money is in my checkbook? But using the checkbook as a primary measurement of cash is flawed. The checkbook only reports what today's cash balance is. It doesn't tell anything about what happened previously to create that balance or the future cash transactions that are expected. The business's cash account is obviously a very useful tool when combined with other cash measurements, though. Before relying on the checkbook, you need to make sure that it balances with the bank. Another method to measure cash uses financial ratios. Ratios are a common tool for financial analysts. They compare one number to another within the company, and then that ratio can be analyzed and compared to previous periods within the company or to other companies. The cash flow ratio itself is one of the liquidity ratios, and it's used to evaluate whether the company has the cash reserves it needs to fund future growth. Right now, analysts are watching Hewlett-Packard's cash ratio as well as the other liquidity ratios. Hewlett-Packard is trying to turn around their operations and they're trying to seek new markets. So they need considerable cash flow to do this. So the analysts have determined their cash ratio and their other liquidity ratios are trending up, which is a good sign, but they're still far below industry averages, which still raises some concerns. The cash ratio is not only used by financial analysts. It could provide a great comparison tool. You could see trending within your own cash flow in your organization, and it could provide a benchmark for future cash flow. Another tool is the cash conversion cycle. This is a useful and I think easy to understand ratio. Just like the cash ratio, The cash conversion cycle is measuring liquidity. More specifically, the cash conversion cycle measures how many days it takes for cash to cycle through the business, beginning with the purchase of inventory, to selling the goods, and finally to receiving the money from customers. So imagine the business activities that affect a dollar bill physically making its way through a business. First, you'd have someone on the phone or on the internet placing an order. Hopefully, we have payment terms by the supplier, so we don't have to use that money just yet. All we did was place an order. The merchandise is received and goes on the shelves for sale. Finally, the merchandise is sold to a customer who we allow 30 days to pay. So still, no money has changed hands. We've purchased merchandise, we've sold it, and no money has changed hands. But finally, we receive the cash from our customers. We immediately pass some of that cash to our merchandise supplier, who has also allowed us payment terms. The rest of the money we hold as profits. That's the cash cycle. Well, it isn't ever this clean, of course, because there's thousands of activities. And it's rare for suppliers to be willing to wait until the business itself receives money from its customers. But it at least shows how the cash cycle works and what is being measured. Here's another way to look at the cash conversion cycle. It better reflects the way the cycle itself is calculated, and you can also see the components of the cycle. The first is days sales of inventory. Then you have days sales outstanding, and the third in the brown arrow is the days payable outstanding. These three pieces together create the cash conversion cycle, or the number of days it takes a dollar bill to cycle through the business on average. The cash conversion cycle is lengthened by days that inventory isn't sold. That's the first arrow. It's also lengthened by days that the money sits in accounts receivable and that the money is not collected from customers. Both of these things put a burden on cash flow. But the cash conversion cycle is reduced by the brown arrow, the days that we hold money without paying it to our vendors. Delaying payment on invoices improves cash flow. Of course, it can put a burden on vendor relationships too. Let's take a closer look at each one of the components of the cash conversion cycle. The first is days sales of inventory, and it's a measurement of how many days the inventory is held before it's sold. This number can widely fluctuate between business models or industry standards. Manufacturers generally have the longest days sales of inventory, as they hold on to raw materials and finished goods and then the final product. The days sales outstanding measures the number of days it takes for the business to collect cash on its sales or receivables. This measurement is similar to your company policies. For example, if your company allows its customers to pay their bills within, let's say, 30 days, the days sales outstanding figure should be somewhere near 30. The days payable outstanding measures the number of days it takes the business to pay its creditors. It should be similar to company policies as well. If creditors allow you 60 days to pay, then the days payable outstanding should be near 60. One of the companies I worked for many years ago found themselves in a very serious cash flow situation. In order to improve cash flow, they worked on their days payable outstanding portion of the cash conversion cycle. How did they do that? Well, they just stopped paying bills, at least until the suppliers hollered several times. Then they would make payments. Well, they would make partial payments. This worked out for a while, as the suppliers were just kind of happy to get money. But within 18 months, all the suppliers had put the company on COD. No more materials could be provided without the cash. This pushed the burden back on the company and, of course, the accounting department, who had to cut checks multiple times a day for all the COD deliveries. More effort should have been placed on the other two facets of the cycle, the days sales of inventory and the days sales outstanding. Let's look at an example cash conversion cycle for Walmart. Days sales inventory is 44 days. So that means it takes 44 days for merchandise to sell at Walmart. That's pretty quick if you think about it. The days sales outstanding is 5 days. That's very short because most of their customers pay cash. The days payable outstanding is 39 days. That means they're paying their suppliers close to 30 days, which is probably the terms allowed. That leaves a cash conversion cycle of 10 days. So that means it takes 10 days for a dollar to cycle through the company. That's a pretty quick cash cycle. A fast cash cycle produces cash for operations and growth. When a cash cycle is large, like 70 days, then cash is tied up in the business for such a long time that outside sources of cash will probably be needed. Walmart has enough cash cycling through the business daily to support much of its operations. Part of that's because of the industry it's in, retail. Part of it is because of how they do their operations. Here's a comparison of Walmart to some of the other big box retailers. Walmart is the largest retailer in the study that I was looking at. They have $1.2 billion in sales every day. That's huge, $1.2 billion a day. And still Walmart's able to convert cash through their cycle in under 10 days. Target's cash conversion cycle is 27 days, so that means that they need more working capital cash than Walmart does. Costco's is even better than Walmart at 4 to 5 days. One more example of the cash conversion cycle, and this comes from my favorite example, Amazon. Amazon is the outlier with a negative cash conversion cycle. Now, the word negative always sounds like a bad thing, but a negative cash conversion cycle is great. That means that people are putting money into Amazon's pockets before Amazon pays anyone else. That is great for Amazon. So how do they do it? Amazon holds their inventory for 29 days, which is better than Walmart. Plus, they have 11 days to collect receivables, which is 40 days in total. But then it pays their accounts payable in 54 days. They hold their accounts payable for 54 days before paying. That's what gives them their negative cash conversion cycle of 14 days. You don't see this very often, but it's definitely a win for Amazon shareholders because it means that cash is available to support the growth of the business. It may not be such a great thing for the suppliers who are waiting for their checks. Up to this point, we've talked about an informal method of reporting cash, which is the checkbook and the bank statement. We've talked about an analytical form of reporting cash, which are our ratios. And now we're going to talk about a more formal reporting method, which is the cash flow statement. The cash flow statement reports historical cash flow. And both of these statements are looking at cash flow for a certain period of time, for a year. It's such an easy concept, cash in and cash out, but the cash flow statement itself really can be very confusing. The traditional cash flow statement can be difficult for non-financial managers to read, and even some financial people have trouble with it. The labels on the cash flow statement, particularly the indirect method, can be very confusing. An increase in one account causes an addition to cash, while an increase in another account causes a decrease in cash. It can also be difficult to see correlation between the indirect cash flow statement and the other two financial statements. Of these two statements, I prefer the direct method. The direct method is really becoming the more preferred method, although some large corporations are still using the indirect method. It starts with your beginning cash balance, and then it adds cash flow from operations, which is very much like an income statement. You can see that there's cash received from customers, that's your sales, and then the expenses of business, inventory, wages, and other operating expenses. To the operating cash flow, then there's cash flow from investments and cash flow from financing. So this cash flow statement is pretty easy to understand, and once you get the experience of reading it, you can see how cash flows in and out of the business in a year. Even though I'd learned the traditional cash flow statement, the indirect method, in college, I was sort of relieved that in practice it wasn't used very often. In fact, cash wasn't really even something that people tracked that much other than your cash account. Well, things are different today, and I'm glad. It wasn't until my first consulting position, when I was helping people prepare loan packages, that I really got familiar with cash and cash reporting. But now we weren't concerned with historical cash, like the cash statements we just looked at, but we're concerned with future cash. Entrepreneurs wanted to know that they would have enough cash in the future, and they wanted to be able to prove to the bank or other lenders that they could repay the loan. They weren't just looking for working capital, but for cash, for specific moments in time, specific periods, or for specific cash needs. So for this type of analysis, we relied on the monthly projected cash flow report. The monthly projected cash flow resembles an income statement, and it's a great place to start if you haven't had experience with projecting cash flow. Many people are comfortable with the income statement or a line item budget, and it's really similar to that. So just like an income statement, it starts out with income, and the income coming from different places, either cash sales or money collected on accounts. And then it lists the outgoings. Those are your expenses, plus down below the subtotal you can see that there are the non-expense payments out too, like loan principal payments and capital purchases. So it's a very easy to understand report. You have cash coming in, and you have cash going out, and you have a monthly balance. What this report does is it helps to identify monthly cash needs, which can then be sought out with some of the sources that we talked about before. This concludes our Unit 2. There's a lot more information in the readings, videos, and additional resources that will shed additional light into the things we talked about today.